walk through recording transactions with you. So we're going to discuss the story from my lectures. So Anne, who started Greater Athletic Performance, she started a business and she's going to need help in recording some of the transactions that are happening because she does not have an accounting background, so she needs some help. So we're going to walk through that story and record those transactions. So you're going to be responsible for doing one of these transaction listings. I'm going to give you a sheet that looks like this, but you're going to put the formula in. Alright, so I already have the formulas in here, so it's going to calculate for me. So you're going to put the account names, what the transaction is, and then the formulas in. Alright, so we're going to walk through these. So transaction 1, Anne invested $35,000 in her organization. Alright, so we're going to put some account names up here real quick. So we're going to need cash account, cash. We're going to need accounts receivable. We're going to need supplies, furniture, equipment, then we have accounts payable, we have Anne's capital account, we have Anne's drawing account, we have service revenue, and we have advertising expense and rent expense. Alright, so we're going to go through these transactions that Anne has. So she invests $35,000. So Anne invests $35,000, which is capital, right? She has $35,000 invested in the organization. So we have $35,000 right here. And she invested cash. So we have $35,000 cash. $35,000 cash, right? So that's transaction 1. So we're going to do transaction number 2. Action. I'm just going to copy this real quick so I can just copy and paste it. Copy this. Alright, so we have transaction number 2. Transaction number 2. Anne purchases $20,000 worth of equipment. She needs equipment for her facility, and she purchases $20,000 worth of sporting equipment, whether it's pitching machines, volleyball courts, basketball hoops. She needs equipment for her facility. So she purchases $20,000 worth of equipment, and she uses cash. So we have cash going out. So we need parentheses, and we need 20,000 cash going out. The parentheses show it's a negative, right? So we have equipment. We're increasing our assets in the equipment account, and our cash account is decreasing by 20,000. So transaction number 3. Transaction number 3. So Anne decides she needs furniture and supplies for her organization. But she decides she's not going to pay cash. She's actually going to put it on account, so she owes that money. Right, so she purchases $500 worth of supplies, 500 of supplies, and $1,000 worth of furniture. And again, she does not pay cash, so she owes that money. So she owes $1,500. Right? She owes that to another organization. Alright, transaction number 4. Transaction number 4. Anne opens up for business. So she opens up for business, and on her first day of opening up, she receives $850 in service revenue. So someone paid her $850 for the service that she provides. So $850 was paid to Anne's organization, and it was paid in cash. So we have an increase in cash of $850,000. $850,000. Transaction number 5. So Anne decides to pay off the accounts payable here. She decides to pay that off. So she has $1,500 cash leaving the organization, right? Because it's going out, you're paying that. And she's paying that account off. So it's a negative because she no longer owes that, right? So that account is reduced back to 0 because she no longer owes that $1,500. Transaction number 6. Transaction number 6. Anne receives $2,500 in service revenue. However, cash is not paid out, but instead it's put on accounts receivable. So Anne is owed $2,500 because someone committed to paying Anne $2,500 for service revenue but did not pay cash. They are putting that on accounts receivable. Alright, so $2,500 is put under service revenue, and $2,500 is put under accounts receivable because that is owed to Anne's organization. Transaction number 7. Transaction number 7. Anne pays $250 to advertise her organization. So $250 in advertising expense. $250. $250. And there's cash going out of $250 for that advertising expense. So that decreases our cash account by $250. Now transaction number 8. Number 8. Anne receives $300 in cash towards the $2,500 that is owed to her on accounts receivable. So she's paid $300 in cash. Now service revenue is already listed, so we don't have to put anything under service revenue, but we do have to reduce the accounts receivable account by $300 because that is no longer owed to Anne. So we have $300 cash going in the cash account and $300 coming out of the accounts receivable account because that is no longer owed. Transaction number 9. Anne has to pay rent for her facility, for the building that she's renting. So she pays $1,700. $1,700 cash for her rent expense. So rent expense. $1,700 for the rent expense. Alright, so we have transaction 9, which is our rent expense. And that's cash going out, right? Transaction number 10. Transaction number 10. Anne decides to withdraw $400. She decides to withdraw $400. So we go to drawing here. Withdraw 400. From the organization. So she no longer has claim in this $400 because she withdrew it from the organization. And that's $400 cash coming out of the cash account. So we have Anne's drawing of $400. And we have the cash of $400 coming out of the cash account because she took that out of the organization for her own personal use. So she took the $400 for her own personal use. Alright, so we should have an ending cash balance of $12,300, which we do. We should have an ending accounts receivable account of $2,200, which we do. We should have a supplies account of $500, a furniture account of $1,000, equipment account of $20,000. So those are our assets. So let's add those assets up. So if you put equals sum of the asset accounts, we add these together, click enter. We have asset account of $36,000. Now we're going to add our, we are going to add our liabilities and our owner's equity. So right now we have accounts payable, which is 0. So we need to add our capital. So we're going to add these together here. So we have equals sum of these accounts here. And it should equal 36,000, and it does. So our assets are equal to our liabilities plus our owner's equity. You see that? So what I'm going to have you do is I'm going to have you take the sheet that I provide, and you're going to put the formulas here in the ending balance, and you're going to do your own transaction listings. Alright, so that's the end of that.